All right, today we're going to tackle one of the biggest questions in finance. Stocks, bonds, or cash? Where should your money go? By the end of this, you'll be crystal clear on what these are and how to think about them for yourself.
So, when you decide to invest, where does your money actually go? Well, it really only goes to one of three places. You're either buying a piece of a business, you're lending your money out, or you're just holding it as cash. That's pretty much it.
And each of these choices, owning, lending, or holding, plays a completely different role in building your wealth. So let's break down what that really means.
Okay, let's get on the same page and define these big three. The core question is, are you looking to own something, lend your money out, or simply keep it safe? First up, stocks. When you buy a stock, you're literally buying a small piece of a company. You become a part owner. So as that company grows and makes more profit, the value of your piece can grow right along with it. This is why we call stocks the growth engine of a portfolio.
Next, we've got bonds. Now, a bond is basically just an IOU. You are lending money to a government or a big corporation, and in return, they give you a promise to pay you back in full, plus regular interest payments along the way. This makes bonds the steady anchor. They provide stability and some predictable income.
And finally, good old cash. This is the money in your bank account ready to go at a moment's notice. It's your on-demand fund, your safety net for emergencies or for jumping on great opportunities when they pop up. So let's just boil it all down. Stocks, that's about ownership and growth. Bonds, that's about lending and stability. And cash, that's all about safety and having ready access to your money. This difference right here, it's everything. So how in the world do you choose between them? Well, it all comes down to this fundamental concept in investing, the trade-off between risk and reward. Think of it like a seesaw. On one side, you've got your lower-risk assets, like cash and bonds, which, no surprise, usually offer lower potential returns. On the other side, you've got stocks. And to get the chance for those higher returns, you have to be willing to accept more risk. It's a direct relationship, plain and simple. And, historically, this trade-off has been super clear. Over the long haul, stocks have shown the highest potential for growth, just blowing past bonds and cash. In fact, cash often struggles just to keep up with inflation, which means it can actually lose its buying power over time.
But, and this is a big but, that potential for higher growth with stocks comes with a lot more volatility. Stocks are kind of like the bumpy, direct road to the mountain summit. It can be a really rough ride, but man, the view from the top can be spectacular. Bonds are more like the smooth, scenic route. Less thrilling for sure, but a much more predictable journey.
Okay, so let's make this practical. What does all this actually mean for you and your money? Well, it all depends on your goals and where you are in life. Let's imagine a young builder. Their main goal is long-term growth. They've got decades, maybe 20, 30 years or more before they'll even need this money. For them, time is their biggest superpower.
So for this builder, a portfolio is probably going to be weighted heavily towards stocks, something like this, to really maximize that growth potential. With so much time on their side, they can afford to ride out the market's bumps and capture those big long-term gains. Now let's look at the complete opposite. Meet the wealth preserver. This person is near or maybe already in retirement. Their goal isn't crazy growth anymore. It's about protecting what they've spent a lifetime building and generating some stable income. And you guessed it, their portfolio mix totally reflects that new priority. See how the allocation is pretty much flipped? The majority is now in the stability of bonds and the safety of cash, with just a little slice in stocks to help keep pace with inflation.
So how do we make this idea of balancing a portfolio really stick in your mind? Let's use a super simple analogy, the three-legged stool.
Your portfolio is just like a three-legged stool. Stocks are your growth leg, bonds provide the stability leg, and cash is your safety leg. Now, if you take any one of those legs away, what happens? The whole thing gets wobbly and unreliable. You really need all three for a solid foundation.
Okay, let's bring it all home. Here's a simple blueprint for how to think about your investments from here on out.
Just remember these three key rules. Number 1, use stocks to fuel your long-term growth. Number 2, use bonds to provide stability and smooth out the ride. And number 3, keep some cash on hand for safety and to be ready to jump on any unexpected opportunities. Because ultimately, understanding the unique jobs that stocks, bonds, and cash do is what gives you the power to build a plan that fits your goals and your timeline. It's about creating a portfolio that works for your life, not for anyone else's.